Today, I want to talk about covered calls, ladies and gentlemen, and specifically covered call ETF. Because, whenever you see a yield of 10, 11, or 12%, your immediate instinct is like, hey, let me buy some and just get that immediate passive income rolling in. But it's never that simple, is it? Let me explain. If you're buying into the Canadian covered call ETFs, just based on the yield, you're actually only doing half the math. And, as an example today, I actually want to put two very different covered call ETFs, ZWC and HYLD, show you what exactly you're trading away for this massive cash flow and why the number you see on the screen for the yield is almost never the actual number you're going to get in your portfolio. So let's get right into it. First of all, what are covered call ETFs? Let's look into this. I think it's very important to understand how these funds actually work. So a covered call ETF holds a basket of stocks and writes or sells call options on those holdings. By selling these options, the fund collects a premium, which is then passed to you as a high yield. So far, it sounds pretty great, isn't it? But there's always a but. The trade-off is if the stocks actually go up in value significantly, and think double or triple digit returns, the fund's upside is actually capped. While, of course, you are getting the income today, you almost always give up the potential for major capital appreciation somewhere down the road in the future. So let's look at ZWC first. I think this one is the most straightforward to understand. I think you would like that. I think of it as the most conservative approach when it comes to covered call ETFs. It holds Canadian blue chip dividend stocks. So obviously big banks, energy producers, utilities, this kind of stuff. And BMO, it's a BMO ETF. They got an option strategy to mitigate some downside risk while generating a pretty decent yield, currently sitting at around about, 6% or so. And why I said it's kind of conservative approach is because it's a very simple strategy. You get the Canadian market exposure and some of the most stable dividend-rich stocks, or dividend-paying stocks, whatever you want to call them. But of course, you'll see that the growth is actually muted in exchange for the steady cash payments. Over time, you'll actually see the shares of ZWC stay, for the most part, pretty flat. Or actually, at times, you can see them decline a little bit, while the distributions roughly stay the same. So if you need that passive income, and I'm pretty sure ZWC pays out monthly, it is a nice option. Of course, note that, nothing is free. So ZWC actually has an MER of not quite 1%, but I believe it's 0.72 last time I checked. So it's a fairly expensive ETF. Again, if they're paying out 6%, minus their MER, you're only getting 5.28 or something, right? And that's if the price stays relatively flat, which is usually not the case. But again, it's pretty awesome if you just need a steady paycheck, so to say, every single month. Nice to see that you can get that. And hopefully if you're keeping in a TFSA, for example, or a SP, you don't need to pay taxes on this because in a taxable account, actually, you do have to pay 20-30% in taxes. Now, HYLD is very different. And this is why I wanted to compare the two. Because covered calls ETF is not a single strategy with a single basket of stocks. And when someone talks about covered calls ETFs, they could be talking about 15 different things, 15 different strategies. So that's something important to remember. So HYLD has completely different risk and complexity level. To clarify, it's a lot more complex and significantly more risky, but with potentially higher upside. So let's look. So it's a Hamilton ETF. It actually is what I call the XEQT. It's a fund of funds, which means it doesn't actually hold the underlying stocks. Instead, it holds ETFs inside of it with different allocations of funds going to them. On top of that, it also applies a 25% cash leverage. What is cash leverage? Well, it's very simple. The fund actually borrows some money to invest more in the underlying funds. And this leverage is what's pushing HYLD to that 11 to 12% yield I was talking about. And while 12% is amazing, I mean, a lot of the time when we count return in global stock market, you roundabout account for S&P 500, for example, growing 10% a year. So if you can get something growing 11, 12% steadily and paying out to you, that's pretty awesome. But nothing is ever this simple, is it? Because, as I said, it's leverage, 25% cash leverage, which means that it amplifies not just gains, but also the losses. So in a strong bull market like we're in right now, I believe, the covered call strategy actually caps the upside, similar to ZWC. So despite the leverage, HYLD might not actually capture the full rally the same way as simple index would. But the fun thing is in a down market or in a, volatile sideways kind of market that keeps going up and down, the leverage really amplifies the losses. And therefore, the fund's NAV, net asset value, can erode incredibly quickly. And when net asset value erodes, the principal base that actually generates the yield of 11 to 12% shrinks as well, which in the future potentially could lead to distribution cuts or long-term capital loss, which nobody wants that, obviously. Which brings me to the most important lesson that you would take from this video, in my opinion. This is the most critical concept when you're evaluating any covered call ETF. And this is total return. This total return is not simply yield, it's the yield you receive plus or minus the change in the share price. So if ETF pays you 10% over the year, but the share price drops 4%, your total return actually ends up being only 6%, which is not nearly as great as 10. And this is the exact reason why a lot of people say that dividend stocks don't necessarily make sense. They might be paying yield, but if the share price stays flat and you're getting 5% yield a year from TD Bank, for example, well, actually, you'd be much better off with a growth stock that went up 6% or 7% without any dividends paid out to the shareholders. Because in this case, your total return will still be higher for this growth stock versus the dividend stock that you're holding. It's the same idea with covered call ETFs. And when comparing ZWC, as I said, and HYLD, as I said, they're very different ETFs, but it's still kind of interesting to look at their distribution yields in the past. ZWC is obviously yielding less, as we've said, only about 6%, but its underlying Canadian dividend stocks are actually a lot less volatile, leading to a much slower NAV erosion, or net asset value erosion. HYLD, on the other hand, has massive yields, very impressive, but it does two things that you don't necessarily want for yourself, which is capping the US market returns upside because of the covered calls, as well as using leverage, which increases the risk of NAV erosion and capital depreciation over the long term. So to summarize, okay, well, they both sound interesting. Who are these ETFs for? Well, let's take a look. In 90, if not 99% of the cases, covered calls are designed for immediate income solutions. If you're currently drawing down your portfolio and you need immediate income right now to cover your expenses, unlike ZWC, it's probably not a bad idea to have as a part of your portfolio. However, if you're in an accumulation phase, which means you're still young, you're still working, you're still contributing to all the accounts, and you don't really need the cash today, these funds are mathematically inefficient. Of course, it's really nice to actually see a little paycheck hitting your account every month. It's kind of fun. It makes you feel more motivated than this hypothetical value going up and up in growth stocks. Because in theory, you don't have to sell anything. You can withdraw the money anytime you want. It's not actually that great again, for long-term growth. By capping the upside, which these covered call ETFs do, you're actually interrupting the compounding process. So if your goal is to build wealth long-term, standard broad market index funds, whether it's global, something global like XQT, or something local like XIC in Canada or VFV in the US, which will actually capture the full upside of the bull market without the drag of option premiums and leverage costs, will historically outperform covered call strategies over long term, so over decades. So if there's one thing I want you to get from this video, it is just do your math. Before you allocate thousands and thousands of dollars for this covered call ETFs with very nice looking double-digit yields, make sure this actually aligns with your investment timeline, because 5 years is very different from 40 years. Right? And that's about it. If you want to learn more about the ETFs I've mentioned, I've made videos about, again, the global allocation ETF like XQT. Another very popular option is just to own the S&P 500 to get all that growth of the tech stock rally, as well as XIC, which is the similar thing for the TSX index in Canada. So yeah, feel free to check those out. They are on my channel and I will link to them down below. But let me know. I'm curious, because I'm kind of here in the vacuum. What strategies are you using? I know a lot of people I've kind of seen in my comments who are using the combination of XQT and VFV for that big growth. A lot of people are using VGERO as well for a little bond cushion, XBAL for if they're pretty close to retirement to have the big bond cushion. But yeah, are you looking to implement some covered call ETFs in your strategy as well to draw some income? Or are there different strategies you personally prioritize in your portfolio? So yeah, let me know in your comments down below. And thank you for watching the video. I'll see you in the next one. Take care.